What affects interest rates on a mortgage? There's two parts. There's the borrower side and the market side. The market side is going to be the treasury bonds. It's going to be the mortgage-backed securities. It's going to be the yield curve. It's going to be the Fed. It's going to be the expectations of the Fed. This market is very thick. Securities are being traded every day. And then a lender, they provide a rate sheet every working day that the bank's open. And then this rate sheet is going to have different hits depending on the transaction. Is it a conventional? Is it an FHA? Is it a jumbo? VA? They all have a different starting point. Now let's start with the term. Is it a 30-year, 20, 15? Is it a fixed rate? Is it a variable rate? That's all going to affect the interest rate. Is this transaction owner-occupied? Is it a second home? Is it investment property? That's going to affect the mortgage interest rate. What's the loan to value? Is the borrower putting down 3%, 5%, 20%, 30%? That all has a different risk for it. However, sometimes if a borrower puts less than 20% down, the rate can actually decrease a little bit because now it's part of a mortgage insurance pool, or that mortgage insurance help mitigate a little bit of that risk. Not always, but sometimes that's the case. How is the credit score of that applicant, or how is the credit scores of the applicants? Remember, for a mortgage, typically they're using the higher of the lower two. Typically it's the mid FICO, but if there's two borrowers or more, they're going to take the middle FICO of the lowest borrower. Mortgage rates based on FICO score are going to be in tiers of about 20 points. So 680 to 700 is one tier. 7 to 720 is another. 740 up to 740 is another one. Now, typically 740 is going to achieve the best interest rate. However, maybe not the lowest payment. The lowest payment, if you're putting less than 20% down, isn't going to come into play sometimes until you achieve a FICO score of 780, which gives you the lowest mortgage insurance rate. What's the transaction type? Is it a purchase? Is it a refinance? Is it a cash out refinance? They're all going to have a different hit. Lastly is the lock period. All things being equal, the shorter the lock period, the better the interest rate. And sometimes transaction determines that. If it's a refinance, you already have the property selected. It doesn't come into play. If it's a purchase, typically you're not going to lock the mortgage interest rate until you're under contract and you have a property or an address selected. On a purchase, it's very common to have a 30-day lock period. So if you're going to lock shortly after your contract, 30 days is going to be the lock period of choice. Sometimes you have a much shorter one. You know, if it's under 22 days, there's no reason to lock for 30. Lock for 22 and you'll have a little better interest rate. However, sometimes it's a longer period. Maybe it's 45 days or that seller needs more time. Well, then you have a choice. You can lock for 45 days or you can wait to lock. Just remember that mortgage rates do change every day.